Good afternoon. It's Pat and Greg at Aligned. And here we are today to talk about a really important issue, which is de-risking your company stock, really building a plan for uncertainty with new tools built by the same technology that is creating the uncertainty.
That's right. That's right. Oh, it's a good point. Concentration risk has always been super important, and we've talked about it a lot, but I think we're at a moment where it's probably more important than it's been in a long time. And
Yeah,
so,
for a couple of reasons. And so if you're an executive at a publicly traded company, this is somewhat urgent. Why is it urgent? Well, it's not unusual to talk about, concentration risk. You've heard that before, and everybody thinks that the company that they know is no problem, right? Because they know it, right? But there's more to the story than that.
yeah, I think there's probably two things going on right now. The first is the market's expensive, right? The U.S. equity market in particular, whether we look at the Schiller PE or we look at, just absolute levels, it's kind of levels that you've seen in major peaks. And so, that doesn't mean there's a crash is imminent. We don't know, but it means the margin for error is smaller. And that just means that the stocks that most executives own a lot of in general are at very high levels. And, I think the second one, and it's harder to quantify, but maybe even more important, is that the early innings of an AI revolution means the ability for a business that seemed like a stable compounding business to be completely disrupted and unended quickly is higher than it's ever been. And we don't think we or the CEOs of the company or the analysts are going to be able to accurately, consistently predict which of those are.
Yeah, I agree with that. So that's it. So if you're a senior executive of a public company, a significant portion of your net worth, your salary is tied to one ticker symbol. And that ticker symbol is exposed to an expensive market, AI disruption that is genuinely unknown. So that's a lot of eggs in one basket of uncertainty. And as you know, we think clients should have a much wider basket today, recognizing that nobody knows the answer to this.
That's right. And so, we also think you should probably tailor it to your needs. So the question that you should understand, and it's something we get to when we go through planning, is what do you need? What's your number? How much do you need liquid, protected, invested to live the life you want and fund your retirement, take care of your family? Because once you know that number, really protecting that number is really more important than being right. And it's making sure what you built doesn't just go away.
That's right. So typically, let's just do like a little bit of a hypothetical executive balance sheet, which is like 60% concentration in one stock is pretty normal, right? That's a pretty normal concentration if you're working at a company. That's where you're building your wealth. That's where your wealth is compounding from. And so let's make this sort of concrete. You're at a public company, you've been there 10 plus years, your net worth is around $20 million. We'll just pull out a number that's easy to go up or down by. And here's what your balance sheet looks like right now. You've got 12 million in company stock, vested RSUs, shares you've purchased, ESPP contributions. You got $3 million in a home, $2 million in retirement accounts, $3 million in other stuff, and $12 million in a single stock, so it's 60% of your net worth. You're feeling good about it. You've been really successful. So what do you do now?
Yeah, well, that's what makes, I think, the risk even greater, because it's not just the stock, it's also, your salary, your benefits, everything that you kind of have is tied to that. And, I'd say the disruption piece is insidious because it's not always obvious when it's happening. Your company's revenues can look fine for kind of a couple years, and then really quickly it's eroded.
Yeah. And so your salary, your bonus, your unvested equity are also tied to that company. So they're tied to that company. And so it's all the same bet, right? And you're kind of double, triple levered into this bet. And so why do people stay concentrated? That's really the question. Why do they do it?
I think one of the reasons that we seem to see and hear a lot is that it's belief, right? It's the business the individual knows, it's the business the individuals help build, and it's the individuals that they have confidence in. You see the strategy, you see the pipeline, you see the execution, and it seems wrong to sell something you believe in. And generally, there's a little bit of a mistrust of the things you don't. So we get that insider knowledge is real, and that bias is understandable.
And then the biggest one for a lot of people is they don't want to pay the tax bill. And we'll talk about a solution to that problem. But here's kind of where we would like push back gently on that with somebody is we obviously know that they know the company better than we do, right? We're not suggesting that. But this AI disruption risk is specifically the risk that even great companies with great management executing well on great strategies, they can get disrupted on something totally outside of their control. And I'm not even suggesting I know what it will be. I don't think people realize how many doors you can swing and hit you back in the back of the head. But this is going to happen, and I don't think there's a perfect hedge for AI disruption.
Look, I think we're generally believers of market efficiency. And if you look at how quickly some stocks have lost 50% of their value, it would suggest things are coming fast that people don't predict.
Yeah, and it makes me a little bit nervous. Not about the broad market, but about specific owning a lot of individual stocks. So the second reason people, don't do it is taxes, right? And if you've held shares for a year with low cost basis, selling triggers massive capital gains hit. On a $3 million sale with a low basis, you could owe $500,000 in federal and state. That's a real psychological barrier to selling. And so we're going to talk about how, we can get around some of these things and defer that tax.
Yeah.
Greg?
Yeah. And then the last piece is you do just keep getting more, right? You're re-upping new equity. You're getting equity comp. So you're getting option grants. So, when you're selling, you're almost just selling in place, and that piece is getting bigger and bigger. So just you have a natural concentration.
Yeah. I think it's the third point often people miss. It's not a one-time issue. It's like it's a perpetual concentration machine because you're constantly getting paid by the same company, getting more stock. And so you need sort of a longer-term de-risking strategy to really make sure that you're doing the right things here. Because look, imagine working at a place for 20 or 30 years, accumulating this big war chest, and then poof, when you want to exit, turns out to be the worst time, right? Like when you're 20, you got plenty of patience, right? But when you're 40 and you're 50, you're running out of ramp. And so it's really important. So how do you address these things first and foremost? And that's where we get to the financial plan.
Yeah.
Knowing your number, Greg?
Yeah. Look, I mean, the plan is something that we think is paramount to this entire process. And it really is a question that we don't know the answer to until we go through it. In fact, sometimes the person we're talking to doesn't know the answer. And that's what's the number that you need? How much wealth, liquid, invested, protected, where you feel like you've won, you fund your retirement, you can take care of your family, pursue what's meaningful to you, and not have to worry about money again.
Yeah, and that's right. So it's like, basically what a financial plan boils down to. If I have a diversified portfolio earning a modest rate of return, how likely it is that I can do what I want to do. It's that simple. And what we really try to do in these processes, connect your wealth to the things that matter to you, to what makes you happy, to your family, to your goals, to your personal, to whatever it is, whatever those 4 pillars of happiness are for you. We want to build a financial plan that kind of meets those needs. And we have tools to address these concentrated stock issues, which, in a really, really smart way.
Yeah. And I think, one of the things we say a lot is at some point, there's a real asymmetry between more money and less money, meaning when you figured out what your number is, above that, the marginal value of the dollars fall off really quickly. But if you were at that number and you unfortunately take risk that doesn't pay off and took unnecessary risk and fall way below it, that's going to really hurt.
Yeah, and especially like, as you get older and you kind of realize what it is that you want, like maybe you don't know what it is you want. When I know my own lifestyle doesn't cost nearly what I thought it would cost to do the things I like to do. And so it changes how you frame and think about risk because you shouldn't be taking risks you don't need to take.
Yeah. And that's really what happens. Once we know your number, we build a plan really around that and protects it. We say, how much do we need to de-risk and when, and how do we do that? And what kind of return do we think a diversified portfolio can generate? Not just in total return, but in cash flows, which really is what you're going to live on. And then how do the grants, affect that timeline? How do we sequence the tax liability? We solve all these problems.
Yeah, and so let's jump right into what is a long short extension. What is that? It's a solution to transfer the low cost basis of your concentrated position into a diversified portfolio. So you're not getting rid of the tax, you're just taking it from stock A to portfolio B, right? And we think this is really important to understand. So you're not getting rid of it, you're just transferring it. So you're taking gains slowly against this concentrated position. Then you're moving into what's called a long short extension, which we'll explain, which will then have that basis in it. So let's get into the mechanics. How do you actually de-risk tax efficiently? And I want to be clear just to say this, it's not magic, right? It's a systematic, rules-based approach really run by AI that creates a probabilistic tax advantage. It does not work perfectly every time. There are costs involved, but it can meaningfully change the math on selling a concentrated position.
Yeah. I mean, we can take a single position and turn it into, through a long short extension with a direct index, that we can create hundreds of individual stocks that replicate broad market exposure. And we're doing that without having to take off 20% in capital gains. So you have your full amount to invest in. So, if you just find these, a 145-45 strategy, for example, which is one that people talk about a lot, that's 145% long exposure and 45% short exposure, which gets you to the 100% net market exposure. The same as owning the straight index. And they're meant to be built with a beta of 1, so there should be behaving at the same rate of change as the market. But you have a lot more positions now, and you're generating both losses on longs and losses on shorts.
Yeah, what was kind of cool is it's sort of the problem we're talking about is sort of creating a little bit of an opportunity here to create tax losses. So there's an interesting AI related dynamic in a period of significant disruption. Individual stocks volatility goes way up, right? And so companies get disrupted news, good or bad, they swing a lot. And that creates the opportunity for this sort of direct index to book losses for you all the time. And like we booked a ton of losses in these programs the first quarter of last year when we had the scare about tariffs. And it was actually like added 2.5% to clients after tax with no leverage with clients after tax returns. So thinking about like how can you use AI, which is doing this, that's really what's doing this stuff to do this in that tax environment. The short-term losses created by the strategy can offset long-term capital gains from selling that position. And that's really what you're doing. And these short-term losses offset dollar for dollar. So the losses we're harvesting are particularly valuable. In the first 12 or 24 months, a well-managed long-short strategy can potentially generate, an enormous amount of losses. And so you can start chopping that position down. Generally, how we approach this with clients is if they're not in a hurry, we do the lower leverage strategies, and then we're kind of averaging out over time, like over kind of a 3 to 5 year period. We get from a zero basis to out of a position. If they're more in a hurry, we'll use the higher leverage positions, and you would be in a hurry if you had way too much of the position and you were concerned about it. Then that would be the situation. Obviously, we prefer taking our time because we don't have a crystal ball into the short term, and we're not trying to say that we do. We're just saying you should be starting to think about these strategies.
That's right. And, it is important. There are costs and there are risks. There's borrowing costs on short positions, margin interest, transaction costs, wash sale rules. Markets don't always cooperate. And when you're taking on leverage, just inherently, you're taking on more risk. This is a probabilistic advantage, not a certainty, but modeled into your financial plan, it really can make the path to diversification way more efficient. And that's the beauty of these products.
Yeah. I mean, they really work. I mean, the most aggressive paths using most leverage have real trade-offs, as you just mentioned. Higher borrowing costs, more complexity, more margin. Clearly not right for everybody. But for executives, depending on how much concentrated stock, you might want to go faster if you really have too much. Again, think about it really simply. If we show you've already blown out all your goals, then what are you waiting for, right? If you got a long way to go, you might take your time, right? You might take your time depending on what your situation is. But, the framing that I find most useful is it's not a decision that you make once. Like it's a system, it's an engine. This is sort of a built-in part of your financial plan that runs alongside your equity compensation. Every new year you get new shares, other shares vest. What's your strategy for these? And so we want to really help you build a plan using these long short strategies. And there's a bunch of companies that do this. Let's go through the math. We'll let the Harvard guy do the math.
Yeah. So, I mean, again, these are illustrative and certainly not guaranteed. Every situation is different. But, this can give you a sense of what the math can look like. So we set up a hypothetical example here. We're selling $3 million per year in a company stock with 75% embedded gain. This is pretty realistic for long tenured executives. So without a loss bank, you're paying roughly $536,000 per year in combined federal and state capital gains. Obviously, it's going to depend a little where you are, but that's the example. But that's the number that, as you said, makes people freeze. They don't want to pay the taxes. But if you take, for example, a 145-45 long short strategy, building losses alongside each sale, the loss bank will grow each year and offset more and more of those gains. So over 3 years, hypothetical cumulative tax advantage approaches $400,000.
Yeah, I mean, and you could do the math. You could be doing this. We've done this in big numbers, small numbers. It doesn't matter. It's just they're the client's numbers, and it does. So the number I want you to focus on isn't the 400,000 and the saved taxes. It's the 400,000 represents in the context of your financial plan. It's the difference between staying concentrated, carrying the AI disruption risk and valuation risk on 60% of your net worth, or being diversified, protected, and on track to move forward. And a simpler way of thinking about it is when the market goes through big swoons, the market always comes back. The broad market comes back. Your stock might not come back. You got to decide like how big of a bet you want to make. Not everything comes back well, right? I mean, the longer you've lived, the more you really know this is true. And I think clients need to just decide. And we're very bullish on the horizon for the broad market because we think profitability is going to go up over time, right? But we can't say for certainty. We can't talk about most individual companies that way.
Yeah, no, that's right. So, I mean, look, I think the punchline is most executives intuitively know they should diversify, but the tax bill is what stopped them. And this is not eliminating the tax bill, it's deferring it, but it is allowing you to diversify tax efficiently.
That's right. And, so we're using fintech technology to really diversify you. And, I think it's really interesting about the moment that we're in is that there are challenges and then there are new tools we have to deal with these challenges, which is kind of amazing, that can help you with this sort of thing. And we're seeing financial technology completely disrupt our industry. So we're really seeing it here in our jobs every day. And we're trying to make sure that we let our clients take advantage of these tools.
Yeah. I mean, look, these aren't something that a human can do with a spreadsheet and a phone. It's the long, short, direct index extension products. And, the better ones we're going to be able to customize more and more to really look more like the portfolios that we run for clients now, which are really kind of surgically precise based on, what our views want to be.
Yeah. And I would sort of say last but not least is you can't do these strategies under like $30 million at most banks. You can do them, however, with RIAs and Fidelity and Schwab at starting as low as like $250,000.
It's a real difference.
It's a real big difference. So if you haven't been offered this yet by your current financial advisor, there's a reason they can't offer it to you. And that's an advantage that we have in the RIA space is whatever's new we have access to, and we will quickly adopt to compete in the space. And so we would love to compete for your business. But so working with an independent RIA actually matters. And as you know, we are a pure fiduciary. We do not take a scrape of any of your underlying investments. We work typically for a flat fee or a very low, reasonable AUM fee. And we police all the fees under that line. So every active manager we don't have any active managers in equities, but every manager we use, we try to grind their fees to be as low as cost in that category as possible.
So, I mean, putting this all together, we do think, we are in an unusual moment right now in the financial markets. And I think, you can start to see it now in the headlines in the equity markets, not at the aggregate level, but at the individual stock level. And this disruption is real and it's accelerating and it's impossible to kind of tell with confidence how it's going to play out. And I think it means it's even more urgent for people to really begin a planning process. And if they have really concentrated positions, think about a solution to help meet their goals while getting diversification. And this is, we think, a very sensible approach.
Yes. And so our ask to you is if you're interested in having a conversation with us, please reach out. We'd love to have a conversation with you or review your portfolio. We'll do a financial plan and give you some advice after we've done a deep dive into your situation and measured everything that we can measure for you. Please like and subscribe to our aligned videos. Thank you for listening.
Thanks for watching.
Thanks for watching.